You've probably seen them everywhere, covered call ETFs. They've become super popular over the last few years, and for good reason. They promise something every investor loves to hear: high monthly income. But today, we're going to peel back the curtain, look past the hype, and find the ones that actually deliver without, a nasty surprise.
I mean, who doesn't, right? That's the dream. A steady, high-yield cash flow hitting your account, month after month. It is the #1 reason these funds are on everybody's radar.
But here's the thing. While those giant yields look amazing on paper, a lot of these funds have a really serious problem hiding under the surface. It's a problem that can just quietly chip away at your initial investment over time.
And that trap has a name: NAV Decay. The easiest way to think about it is like this. Your investment is water in a bucket. A good ETF, well, it grows that bucket over time. But with NAV Decay, those big dividend payments are like a leak. And if the fund isn't growing fast enough to plug that leak, your bucket just slowly empties out. And that means those future dividend payments get smaller and smaller.
So, how do we find the funds that actually avoid this trap? Well, here's the game plan. First, we'll dive into the covered call puzzle. Then, we'll hunt down the funds that have solved for NAV decay. We'll uncover Bitcoin's wild yield secret, break down something called the 50% strategy, and finally, we'll wrap it all up with an investor's checklist you can use for any fund.
All right, let's get into it. Our mission here is really simple. Find the highest-yielding covered call ETFs that have actually managed to grow their share price since they launched. We want the full buckets, not the leaky ones.
We're starting with a pretty big pool of candidates. The source material for this whole analysis kicked off with a database of 65 different covered call ETFs. That is a lot to sift through.
But watch what happens when we apply our very first filter. We just ask one simple question. Has the net asset value, or NAV, actually gone up since the fund started? The results are, well, they're kind of shocking. Out of those 65 funds, only 27 have avoided NAV decay. Think about that for a second. More than half have actually seen their share price go down over time.
So, from those 27 survivors, we're going to zero in on the absolute best of the best, the top 7 highest-yielding funds that also managed to grow. So, who actually made the cut?
You might be surprised to find out that the top 2 spots are completely dominated by funds that hold a very specific, and let's be honest, a very volatile asset. Let's see how this actually works.
And here it is coming in at #1, MAXI, the Simplify Bitcoin ETF. And no, that yield is not a typo. A trailing 12-month yield over 32%, all while growing its share price. How? It sells options on pretty much 100% of its portfolio using an out-of-the-money strategy. We'll talk more about what that means in a bit. Yeah, the fee is a little high, but with that kind of performance, you can see why.
Right behind it at #2 is BTCI, another Bitcoin covered call ETF. Its yield is also through the roof, but the key difference here is all about stability. See, if you look at MAXI's payouts, they jump around a lot from month to month. BTCI, on the other hand, really tries to deliver much more stable, predictable monthly income. And for a lot of income investors, that predictability is a huge, huge plus.
So, what's the secret sauce here? Why are these Bitcoin funds just dominating? It really comes down to 2 things. First, the thing they hold, Bitcoin, has been on an absolute tear, up over 80% in the last year. It's way easier to avoid NAV decay when your main holding is skyrocketing. But second, and this is the real key, volatility. Bitcoin is almost 5 times more volatile than the S&P 500. And for a strategy that sells options, volatility is basically fuel. More price swings mean the fund can charge more money, or premium, for the options it sells. And that premium translates directly into those massive dividend checks.
Okay, but not all of the winning funds are riding the crypto roller coaster. The next group of top performers uses a totally different playbook. It's a really interesting hybrid approach that's designed to give you a little bit of both, income and growth.
Let's meet the hybrids from Global X, QYLG, XYLG, and DYLG. Their secret is right there in the name. They only sell covered calls on half of their portfolio. The other 50%, they just leave it alone to track its index, like the NASDAQ 100 or the S&P 500. So it creates this really clear trade-off. You get less income than a fund that's 100% covered, sure, but you get to capture way more of the market's growth.
Now, if you've ever looked at the price charts for these funds, you've probably seen something really weird. A huge, sharp drop in the share price every single December, followed by a gigantic dividend payment. So what in the world is going on there?
It all boils down to a tax rule. These ETFs are something called a regulated investment company, or a RIC for short. And the law says they have to pay out at least 90% of their income in capital gains to shareholders every year. So in a good year, that 50% of the portfolio that's just riding the market creates these huge gains. The normal monthly dividends aren't nearly enough to hit that 90% target. So come December, the fund is forced to make a massive catch-up payment. The share price drops because that cash is literally being taken out of the fund's assets and put directly into your pocket.
And this brings us to a really crucial strategic difference. Those 50% hybrid funds tend to sell at the money options, meaning they're set right at the stock's current price. This lets them collect a lot of premium, but it caps their upside. The Bitcoin ETFs we saw, they sell out of the money options, which are set above the current price. They get less premium, but they leave way more room for the asset to run. It's a small detail that has a huge impact on how the fund is going to perform.
Okay, we have covered a ton of ground. So let's pull all of this together and distill it into a simple, practical checklist you can use to look at any covered call ETF out there.
Just to round out our top performers, the last two funds on the list highlight a couple more key things to look for. You've got IGLD, which is an actively managed fund selling calls on a gold trust, giving its managers more flexibility. And then there's QUSA, which is also actively managed, but its managers handpick what they call quality US stocks, instead of just following a big index.
So here it is, your 5-point checklist. Number 1, always check the NAV trend. Is the bucket leaking or is it growing? Number 2, what's the option strategy? At the money for more income now or out of the money for more growth potential later? 3, what's the coverage? Is it 100% for max income or a 50% hybrid for balance? 4, what's the underlying asset? Its performance and volatility are the engines driving everything. And finally, number 5, check that expense ratio. Make sure the fee you're paying makes sense for the strategy.
Now, a really important disclaimer from the source material: just because these funds did great in the past doesn't guarantee they'll do great in the future. The crypto funds were amazing while Bitcoin was soaring. The hybrid funds did really well when the stock market was strong. You have to understand the strategy to have any idea how a fund might perform when market conditions change.
So we've seen funds built for pure maximum yield. We've seen funds designed to balance growth and income. And we've seen specialized funds that focus on specific assets. The real question isn't just which fund is the best. It's figuring out which of these strategies is the best fit for you and your financial goals.